Hey there, everyone. Dave Keller here with Market Misbehavior. I'm the President and Chief Strategist of Sierra Alpha Research based here in Redmond, Washington, and welcome to my weekly show on StockCharts TV. It is so great to be with you here every week on StockCharts TV, bringing you latest thinking, ideas, hopefully just thoughts and perspective to nudge your thinking, all demonstrating hopefully the power of the StockCharts platform, which is a formidable technical analysis tool that I use every single trading day. What I thought we'd do today is focus on gaps. I actually get a lot of questions on my market recap show called Chart This with Dave Keller. You should all tune in, by the way, every weekday, 5 p.m. Eastern, 2 p.m. Pacific. Also, by the way, while we're talking about stuff that I'm doing, our Market Misbehavior podcast had two really good interviews last week, including our latest episode with Gary Antonacci. Gary's the author of Dual Momentum Investing. He's had an incredible career starting in the industry in 1974, working with some incredible traders like Richard Dennis, like Paul Tudor Jones. He shares some anecdotes and lessons learned from working with some of those luminaries in the financial industry. We talked all about momentum investing, what fueled and inspired him to write his book, and his updated thinking. He's got another book in the works, as I learned from our conversation, but we talked a lot about all things momentum. You can check both of those things out, my market recap show and my podcast, on our YouTube channel called Market Misbehavior, and I appreciate you tuning in. Anyways, as a side over, back to the show. We talk a lot on my show about price gaps, and when I do a mailbag episode, I often get at least one question a week on price gaps. So I thought I'd just take a little bit of time and address that, because we've actually had a number of price gaps recently, most notably on the S&P 500, but also other charts like Meta and Microsoft and other charts you may be less familiar with. What we're going to do today is look at those price gaps in a little more detail. I'll share with you, a lot of people have a lot of different ways of thinking about price gaps. I'll sort of fill you in on how I approach them, how they inform my thinking after the gap has occurred, how I use those levels and that range as an indicative price range for support and resistance. And then we'll talk about some specific levels to focus on with various charts that we're reviewing. What's great about price gaps is they're on any sort of daily chart, right? You don't really get price gaps on intraday charts. You don't really get price gaps a ton on weekly charts, although you will. And you certainly don't get them on hourly charts or anything like that. And the reason is because a price gap is formed when there's no overlap between one session and the next. Let's get to the charts. This is a chart-oriented show, so let's get to the visuals. We're going to start with First Solar. And the reason why I was inspired to do this episode today is because I'm sort of checking out the market carpet, reviewing what's happening here as the Monday session is sort of halfway through. And I find First Solar is one of the biggest drops in the S&P, down about 10% now as we're recording the show, sort of early afternoon Eastern time on Monday the 19th. And the lower move today brings First Solar back within the range of the gap that we experienced in early May. Now, again, what is a price gap? So a price gap is any time there's no overlap from one day's session to the next, right? So the reason why you see it a lot on daily charts is because you have a session from 9:30 a.m. to 4 o'clock p.m. Eastern. Then you have this gap in time before 9:30 a.m. Eastern the next day. And if there's any earnings, if there's any news, if there's economic data that comes out before the open, what happens is the market will open somewhere far, in some cases, very far away from where it closed the previous day. We see it most often on equity charts around earnings, right? Because when earnings are announced, there's often a big change because earnings are reported after hours, after the close, or before the open. So when the next session opens, we've revalued the stock based on optimism or pessimism related to earnings and forward-looking guidance and all that stuff that comes out of an earnings call. So gaps happen often. You won't see gaps as much on like commodity charts, right? Because you don't have as much like earnings flow that would cause things to reset from one day to the next. So you will get certainly gaps with economic data for sure. You don't get gaps as much with currencies because they're traded 24 hours, right? And so same with like Globex futures or something, cryptocurrencies. Gaps don't happen because there's really no gap in time from one close to the next, right? With cryptocurrencies or with like the Japanese yen, they trade 24 hours. So there's just a point in time once every 24 hours, which is considered the close. And then that basically, trading just continues. So gaps are really more specific to equities, certainly way more common with equities than you'll see in other asset classes. So let's talk about the gap that we've seen most recently with the chart of First Solar. We'll talk in detail about the chart of First Solar, and then I had some other charts queued up that I think are some good to review in terms of gaps. So here's the most recent gap that we're talking about. When we closed around 155, we'll call it. And then the next morning we opened around 175. It was a big gap higher. And this was when, if I remember right, there was news related to solar stocks that came out. And I think it was, regulations or unwinding some of the green energy policy changes that the Biden administration had made, but it wasn't as negative as expected with some solar stocks. So things like First Solar gapped higher because it looked like they would actually do better than other sort of renewable energy types of names. So what had been happening on the chart of First Solar, we'd been in a pretty good downtrend. Fourth quarter of 24, first quarter of 25. Made an eventual low second week in April. This is as the S&P and the NASDAQ, of course, were making their low on April 7th. Right around that week is when we had the low here. But from there, it's sort of been choppy, right? And so during this period, First Solar was basically in a basing pattern. And a basing pattern is where you have like a sideways pattern on the chart. I tend to call a basing pattern anything where you draw a rectangle and it kind of describes the price action pretty well. Everything's kind of in that rectangle. That's a basing pattern. So you have consistent resistance around 140 to 145. We have support around 120 to 125, and the price is basically bouncing between those two levels. Then we finally broke out on May 12th, and the next day on that news, we had a big gap higher. So that's a price gap. So what does that mean? Again, it means there's no overlap from one day to the next. Something happens. So the way that I actually think about price gaps within the larger context, I actually keep it pretty simple. I tend to think of price gaps as support and resistance ranges, right? I think of that as a level, right? As a range of levels that you want to pay attention to. So let's annotate the chart a little bit here. And I would say what a lot of people do is they have very specific things they think about, but we'll get to that in a moment. So, support and resistance levels, right? Anytime you draw a line and it connects a bunch of peaks or a bunch of lows, that's a support level, or in this case, a resistance line, right? A level of price resistance where we've had a number of tests around that level. That's at 140, and that's why that break above 140 makes a lot of sense. But here we actually have a range. So what I like to do with gaps is draw a shaded area. And what I do is use the rectangle tool. So if you go over here in the toolkit, you click on annotate, then go to the left and click on rectangle. If it starts out with like a big heavy color, like that's fine. Just kind of draw it where you think it's going to be. Then click on the color, slide this guy back over here, which will make it more and more transparent. Get it to a good shade. What I like to do is make it a shade where you can see it, but you can still see the price action behind it. And then kind of put it where you want to be. And anytime there's a gap, I often, if you look at my chart, you'll often see those levels. So here I'm kind of looking at this gap here, and then I just extend it forward. And I usually keep the line very thin, so I'm just looking at the shaded area. So what that gap does is it reminds me, okay, this is a price gap. Now going forward, I want to pay attention to that. Same thing like back here. We had a price gap here. So when that happens, I just draw that line. And I do it because more often than not, the price will find resistance in the gap from below. And so it ends up being, instead of like a horizontal line that becomes resistance, it's a range, because prices often come back to test that gap resistance before rotating lower. And so that's why I want to keep an eye on those levels. So when we gap higher, I sort of think of that, all right, that's bullish. Right? The fact that we gapped up is bullish. But one of two things happens after you have a big gap higher. We gap and fail, which is, I think, what First Solar is showing right here, or we gap and run. And I've got some other examples of stocks that have gapped higher and then run higher. So what causes these two different sort of post-gap moves? Well, this is a dangerous one, this sort of gap and fail pattern where we gap higher, but then we stall out, right? After you have that big day where we've changed, right? And obviously a lot of upside momentum during that day. It's all about what happens next, right? Do we get additional buyers coming in? Because what's happened is the stock has gone from 155 to 190 plus within 24 hours, right? Or within one session. So the only way that stock continues to go higher is if a bunch of people really want to buy into it. A bunch of investors want to buy more and even accumulate more, even though the stock's been marked up by, $30, $40 within about 2 days, right? So the only way that stock keeps going higher is if people are so optimistic about First Solar, they're willing to pay a marked up price, right? Imagine if you go to the store and something you want to buy is 20% more expensive. If you still want to buy it, that's like the gap and run, right? It's still worth owning, even though it's way more expensive. But if you look at the price tag and say, all right, 20% higher, no way, it's not worth that. That's when the stock kind of pulls a First Solar and starts to rotate lower. There's an absence of willing buyers willing to pay more and more. What's happening here is the gap is treated as an opportunity to unwind positions. So people that bought back here in this consolidation phase, right, in this basing pattern, are sitting on a pretty decent profit, right? If you bought back here at 130 and all of a sudden the stock's at like 190, 195, you're cashing out at a pretty decent markup, and you're thrilled to take a profit and get out while the getting's good. The problem is if enough people sort of unwind those positions, that's when the selling starts to come in. And what we see from First Solar is we gapped higher, we pretty much stalled out, and then rotated lower. So now we're back within the gap range, and so failing to find support within the gap is a huge is a major problem. Now let's also look at a couple other things, because gaps don't happen in a vacuum. What's good about price gaps, I often get people saying, well, how do you trade a price gap, as if you only look at the gap and not look at anything else. And what I would remind you is one of the benefits of technical analysis is when you look at a chart, you've got a lot of different tools that you can bring to bear, right? Depending on what questions you're trying to answer. So when you have a gap, I find it's often helpful to look at other techniques and see if we can triangulate some sort of levels or patterns between these different approaches. So a couple things stand out to me on the chart of First Solar. First off, when we gapped higher, we gapped right to the 200-day moving average, right? We opened below and closed above it. So not only did we gap higher, we also gapped above a big time moving average that many investors pay attention to. The last couple times we've attempted to get above the 200-day, we have failed. Here we had a shooting star candle, which is a pretty classic topping pattern before breaking back below the 200-day. Here we actually never closed much above the 200-day. One day we closed almost just a tick above, and then that was it. So we failed to break above the 200-day now over the last 6 months. So the question is this time different? And the chart's basically telling you, okay, we're gapping higher, but it's above the 200-day. We failed to hold it before. Is this time different? Again, it looks like this time is not different. So number one, the 200-day moving average. Sticking with our analysis of the price, and I would say, hold on a second. Let's save what we did here. I'm going to bring, see how the high, I was going to draw a Fibonacci retracement. See how the high is behind that label? All you need to do is add a little more time. So I'm going to add another month. There we go. Now that gives us a little more space. Let's annotate again. And I'm going to draw a Fibonacci retracement. So here we'll take the high and we'll draw it down to the low. So that's the low from early April. That's the high from June of last year. All right, we can save this again. Now we've saved our Fibonacci retracement. So here we can see that when we gapped above the 200-day, we also closed just above the 38.2% retracement level based on that June 24 high to April 24 low. So this represents 38.2% of the way back up to that previous all-time high around 306. So we've gapped above the 200-day, also gapped right up to that resistance level, right? So we have a number of things telling us this is probably the extent of this upside move. We really need to see a valid break above like 190 and further upside above that level to validate the uptrend. We really didn't get that, right? 2 days later, we're trading back below 190, which takes us below the Fibonacci retracement. The next day, we're back below the 200-day, and obviously sellers have come in. I would also note, on top of the moving average level and the Fibonacci retracement, we also have the RSI, right? So the RSI became overbought, which is pretty common when you have a gap higher, because the way that RSI is calculated It says what's the average up day and the average down day over a period of time. It's a basic ratio that fuels that indicator with some exponential smoothing and other math that we don't have time to go through. So when there's a big gap higher, that often causes the RSI to become overbought because all of a sudden the average up day is a lot stronger because of this one-day gap that sort of skews the results to the upside. So RSI often becomes overbought. So I've learned to look for a break back below the overbought region as a sign that the breakout may have failed, certainly may have stalled out. So what we can see on the surface, First Solar looks like a gap, and what I'd call a gap and fail pattern. We gapped higher, we never really followed through, and then started to rotate lower. But I think what I've shown, hopefully, is that when you combine it with other charting tools that you have, things like moving averages, Fibonacci retracements, RSI, or another momentum indicator, we can start to further validate the gap that we've seen and see whether there's enough follow-through to believe that there's more upside to be had. So that's a kind of deep dive on the chart of First Solar. I've got a couple other charts here that have had recent gaps. Let's look at those. And again, these are recent examples. If you look to the left on most charts, you will find gaps are actually pretty frequent, certainly with certain types of equities. And so we can use those as examples as well. Microsoft recently gapped higher. This was after the April 7th low. We rotated higher. Remember focusing in on this level on my show around 395. That was the swing high in March, swing high in mid-April. Late April, we're getting right back to that level. The beginning of May, all of a sudden, big gap higher, and then we rotate higher. So First Solar, gap and fail. Microsoft, gap and run. That's what I call a gap and run pattern. A gap higher. Remember what we talked about with First Solar, what causes the gap, right? A revaluation in the stock higher because of news or earnings or something like that. A gap and run, in this case because of the Q1 earnings report from Microsoft, we gapped higher, but then we continued to push higher. Look how about a week later we'll really start to move away from the gap and continue to accelerate. So what the chart is telling you is that even though Microsoft was marked up from $395 to $425, $30 markup, we're still seeing buyers come in a week later, still seeing investors willing to accumulate more Microsoft on the way up, even though it's way more expensive than it was before the gap. And so the gap and run pattern represents optimism, represents that investors, new buyers are coming in or are willing to accumulate more, and that gives the opportunity to ride to further upside. Note on the chart of Microsoft, by the way, we became overbought on that gap day, and we never exited the overbought region all the way through today on Monday, May 19th. We're still overbought. So that what I mentioned before, gap and fail, the RSI often comes down below the overbought region here. We remain stronger. Howmet Aerospace, HWM, is another one that gapped higher. And again, remembering what we talked about before, if you look at a trend line, just drawing a horizontal line on the resistance here, right? Here was the resistance level around 140. That was the peak in mid-February. You can see we kind of traded up toward that level a couple times, but then the gap finally powers us above the February peak, putting us to a new all-time high. Similar to Microsoft, we have a gap. And then unlike First Solar, which rotated lower, here we have additional buyers coming in. Similar to Microsoft, gap and run, we also have the RSI that becomes overbought and stays overbought. So that indicates optimism, indicates new buyers coming in and pushing price to the upside. Meta, so let's look at, those are some charts that have had gaps higher and then have had a run higher. Here are some that are sort of an open question. These are stocks that have gapped higher, haven't really run much, but haven't broken down yet. And these are things that I think I would be actively watching. One would be Meta. So remember what we talked about in terms of highlighting that range. Again, I do a rectangle annotation. I like to use one of these lighter colors. You can see I do this a lot because I have the lighter colors on here. If you don't have those on your palette, just pick a color that you like and then just make sure to put that slider down to a more transparent treatment of the color, and then you'll be able to draw these really cool rectangles, which I think kind of make it. Here we go. And I don't like the line. I like the border to be kind of clean. So there we go. All right. So here what I've done is basically drawn a gap or highlighted the gap from around 610 to around 620. That was the gap higher here. This was about a week after earnings. This was the earnings related gap. So we could draw another one here. So if you look at charts that I have all the time, I often have a bunch of these rectangles, and that's highlighting recent gaps. And then eventually when the price has kind of moved on from that gap and it's no longer important, I kind of delete the rectangle and update it as needed. But these are two kind of gaps that have happened from the low. Here's another one down here, which I won't draw for now, but you can see how we can use those gaps just to highlight support levels on the way up. These are great places to put stops, by the way. That's one way that I would think about it. If you buy the gap, use the gap as the stop, right? That level as a level of support. And if we violate the gap to the downside, that tells you your stop is triggered. You might want to reconsider your long position. So most recently, we can see the gap higher. This was the earnings gap that we see. Here's another gap early May. We traded higher for like 2 days, which is great. But then we've pulled back a little bit. Now we're kind of just sitting just above that gap. So here's where I would expect support, not at a specific level necessarily, but more at a range, kind of that 610 to 620 range, because this is the range created by the most recent price gap. Now, again, different from Microsoft and Howmet, which gapped higher, became overbought, stayed overbought. Here we didn't get that. We were overbought on the gap day or maybe 2 days after, but now we're actually below that overbought region. So again, telling us it's a little different. Here's Monolithic Power System, ticker MPWR. This is a semiconductor name. Again, we'll use our rectangle. That's not what we do. I just taught myself how to do it and then I forgot. There we go. Use the rectangle tool. We've got a pretty good color picked. So here I kind of, again, use this gap as a range. I can see that we gapped higher. We've now traded above the 200-day. What concerns me about MPWR is it looks a lot like the chart of First Solar. Gapping higher, closing above the 200-day, eventually failed the 200-day, failed into the gap. Do we get a repeat of that here? Right now, today, we're actually closing back below the 200-day. That's minus, check number one, strike one. Strike two, or maybe strike 2 and 3 would be breaking below that gap range. So here I'm seeing support kind of in the 660 to 680 range, which would be the range of this purple shaded gap. Similar to what we saw with First Solar, we became overbought, came out of the overbought region. So we can see the difference between this kind of pattern, the gap and run, and these kind of patterns with Meta and now with MPWR that have initially moved higher but now have started to fail a little bit. So when we get that pullback, I always focus on that gap range. That's where I like to set price alerts within that range just to remind me, okay, this was a gap that is now being tested, maybe being filled. And if we break below that gap range, that's when I've learned to get out of the way. Now, why would I get out of the way if we fail to hold this gap? Why is that so important? We have to remember there are different types of gaps, okay? Let's look back here like on Meta, right? This gap right here is what we would call an initiation gap or a breakaway gap. This is a stock that was in a downtrend and then something changed, right? We had a double bottom around 480. We've now gapped higher. So a technical analyst like myself would call that a breakaway gap. This is initiating a new move. It's a new trend. The trend had been down. It's now going up. That's a new gap. Something that kind of happens in the middle of the trend we'd call a continuation gap. This is something that's happening mid-trend, often provides some short-term support along the way, but as long as we continue to trade higher, that tells you the gap is just basically continuing the uptrend. What you want to watch out for, and what maybe has happened here with like a First Solar, what we call an exhaustion gap, right? Something that has gapped higher, but then we start to roll over. So gaps often happen at the end of a move, and it suggests that whatever optimism we had going through the trend, and it's a better example of an exhaustion gap, but was something that had been trading a long time and then has a big gap higher and then starts to fail. And that indicates an exhaustion of buyers. That might be what we're seeing here with something like MPWR. Right? We've had a nice uptrend, then we have a gap, and then we stall out. And so if we break below that gap range, that sort of confirms, yep, that was probably an exhaustion gap. Yep, you probably want to get out of the way and avoid riding this thing down a little bit further. Now, most obvious gaps on the major indexes, things like the QQQ, things like the S&P 500, you can see this green shaded area highlighting price gaps. And I follow gaps on the S&P chart all the time. I had this one on the chart back here, which is a great reminder in mid-January that we were testing the gap support. As we had tested many times, we held it and broke higher. I think that was a good indication that we were going to retest the previous highs. Here, we've had a couple gaps along the way, but this one I think is pretty meaningful. This was the gap when the tariff all clear signal sort of comes in, or the latest gap high related to that. Coming out of the April lows where we had sort of the initial change. This was the agreement with China, or the announcement with China that they were going to pause or at least delay the tariffs for a little while. We can see this gap ranges from around 57.20 up to around 57.80. And that actually lines up really well with that March peak. So gapping above the 200-day, gapping above the March swing high, pretty bullish, which means as long as we continue higher, we're in pretty good. We're looking like a gap and run pattern on the S&P, but I'm watching very closely that support level. And I would say if and when the S&P would come back, test that gap support, test the 200-day and fail, that would be a sign of a likely deterioration and the next big leg lower. So there you go. You've had a quick version of how Dave uses gaps here on StockCharts TV. I hope you found that a helpful rundown through First Solar in a little more detail, talking about how we use gaps with some other technical indicators, what gaps really represent, the different types of gaps, exhaustion gaps versus breakaway gaps, and then some examples, including the S&P 500, of recent gaps and how we use them as potential support and resistance. If you have questions on what we talked about, drop a comment below. I'd love to see what questions or feedback you have on today's show. Don't forget, by the way, to check out my market recap show called Chart This with Dave Keller. That's every trading day at 5 p.m. Eastern on my YouTube channel called Market Misbehavior. Also, our Market Misbehavior podcast. We've had some really good episodes. Gary Antonacci, Nick Raish of the Earnings Scout, a lot of the other great interviews in recent weeks. You can find those all again on my YouTube channel. For Market Misbehavior, I'm Dave Keller. Have a great week, and remember, it's always a good time to own good charts.